All right, let's get started. Hello, everyone. I'm Jinhua Zhao, Professor of Cities Transportation at MIT. Welcome to the MIT Mobility Forum, organized by the MIT Mobility Initiative. Today, I'm really excited to have Reilly Brennan, the partner from Trucks VC, joining us to have a fireside chat with John Moavenzadeh on the evolving role of venture capital in mobility. John will moderate the session today. Just before that, I have to note that today is actually the last session of the spring 2024 season of the MIT Mobility Forum. Thank you again for joining it. And toward the end of today's session, I would like to actually invite everyone to share with us your expectation for the future sessions. What topics, technologies, processes, locations, social phenomena you want to be discussed in this forum, right? So toward the end of the session, I will invite people to type your thought into the chat. We'll compile them, and as much as we can, invite the relevant experts, scholars, practitioners to join us in the forum and respond to the thoughts. Without further ado, let me pass the forum to John. Yeah, please.
Super. Thanks so much, Jinhua. So for all of you who know us at the MIT Mobility Initiative, you know that our key word is system. So we're always thinking about the broader system that involves transportation. And that, by definition, involves all of the adjacent systems: energy, infrastructure, data, and very importantly, the financial system. And so it's important for us to kind of understand how developments and trends that are happening in the financial world are actually having a material impact in the mobility space. And that's why I'm so excited today to have Reilly Brennan join us. Reilly he co-founded Trucks Venture Capital in 2015. It is, for those of us in the mobility space, we see Reilly in our inbox, typically on a weekly basis, with the publication of a really excellent newsletter that captures many of the key salient newsworthy items and trends happening in the mobility space. Reilly is... before founding the Trucks venture capital firm, he was the head of research at the Stanford Automotive Lab. He's held numerous positions in industry before that, a graduate of University of Michigan and the Stanford Business School. So Reilly, we're super excited to have you join us today, and thanks for joining.
Thanks, John, for having me.
For those of you just coming on, we have asked you to just quickly type in your name, your organization, and your location into the chat, so we have a sense of who's all with us today. So let me just offer kind of a brief introduction into the world of venture capital. And I'm going to go through a couple of slides very, very quickly. So there we go. Okay, so what is venture capital, right? At its core, it's a trade-off between venture capitalists who provide money for entrepreneurs in return for an equity stake in the company. Now, those funds come from private investors, from individuals, from institutionals. We also, of course, entrepreneurs can receive funding from other sources, from corporations, from government. That just to close out the picture, there's a sort of closeout of the venture capital deal when a company will either IPO, or the VC will have a form of exiting. So one of the things that we talk about in the venture capital world a lot is kind of surviving this valley of death. So this is in the early days of an entrepreneur's journey, where they have received initial upfront seed or pre-seed funding, and they sort of have to go to that growth stage. And it requires a significant investment in capital. And sometimes it's really tough to get through that period. So this is kind of a concept that comes up a lot with entrepreneurs as we think about the venture capital space. And so if you think about kind of a hypothetical portfolio, you might have a couple out of 10 companies that a venture capital firm may invest in. Maybe 6, 7, 8 of them sort of do okay, but 1 or 2 of them earn these kind of massive returns. So it's this type of a kind of a risk profile, because we all know that many startups actually do fail. So it really is kind of a tough business. And if we look at mobility venture capital investment on a global scale, these are data from PitchBook. What we see is that we really reached this astonishing peak in 2021 with about $93 billion of venture capital on a global basis flowing into the mobility space. And really a big chunk of this, maybe 75, 80% of this, was really around 3 technologies: electric vehicles, electric vertical takeoff and landing vehicles. And then what we saw is this, and autonomous mobility being the third one. And then what we saw is that this overall volume has really declined significantly just over the past year. And, you know, it's just a characteristic of, you know, financial markets and how this translates sort of into the real world. There's a linkage here, and we might probe on this a little bit more, but this is the price of lithium carbonate, obviously the key processed material in electric vehicle batteries over a 5-year period. And you can just see this kind of tremendous sort of volatility in the price of that material. So that's a way of kind of giving sort of a quick introduction. Reilly, you're really one of the most thoughtful people that I've met in this space. And I'd really be curious, maybe if you could just share a couple of, you know, your observations and so forth at Trucks Venture Capital.
Thanks, John. And thanks for having me. I really appreciate it. Maybe one more idea to add on to your slides is that, you know, fundamentally, when you do venture, you're getting paid for your risk that you're taking. And venture is probably the riskiest moment in time to invest in a company. And often the ideas that we look at, many of them won't ever become great companies. So when we're making our investment, arguably you're paying the lowest price for that equity in the long history of the company's life if it's successful. If it's not successful, you're probably paying the most expensive equity because it's going to be worth nothing in 24 months or something like that. And so it all kind of depends, like in all things with finance, where on this kind of risk reward curve do you want to place capital? And venture is one of the riskiest ways you can do it. And of course, when it goes right, one of the investments you make will pay for the things, as John mentioned, that didn't go right, and the investments that maybe only returned 1x or something like that. And so it's really interesting to think about as something you do all day long. I think venture in some ways is a little bit like, if you like worked at an ice cream shop or something like that, where it's an activity that if you look in the totality of a financial portfolio, you wouldn't want to put all your money in venture. And so for the people who spend 100% of their time in venture, it's really kind of an interesting job. And most VCs tend to be generalists. So, they'll look at fintech one moment, they'll look at healthcare, and then they'll look at social media apps or something like that. And the origin of our fund goes back well over 10 years ago, but really it was a conversation that my now partner, Jeff Shocks and I were having, which is, and transportation is such a big industry. It's really, frankly, an industry of industries where, you can put within it automotive and commercial trucking and insurance and aviation and all these things. It almost demands and deserves its own venture focus, right? And so our belief when we started our modest effort, which we call Trucks, is that we would theoretically be able to evaluate deals better because it was the only thing we were doing. So taking not only the thin slice within finance of looking just at venture and early stage, but within that, just transportation. And we tend to use the term transportation more than mobility. because we find that when we get into things like rail and things that the consumer doesn't touch and often aren't applied to like shared business models, that transportation tends to be a little more appropriate for some of the work that we do. But it's the wide gamut of things, from very small vehicles like bicycles and scooters all the way up to airplanes. And I think, particularly for those of us on the call, that's what's so exciting about this space, is that it's such, transportation has always been kind of this multidisciplinary world that, particularly within a university environment, almost demands the different skills and people required to bring some of these ideas to life. Even if you just think about a car company, you have business people and designers and policy people and, great artists and customer service and sales and marketing, just like all the different facets you can bring to bear, you can see in a successful company in transportation. And so that's why I've always thought, particularly within universities, that the automobile, but transportation more broadly, should be studied more seriously. So we're not, of course, a university, we're a venture capital fund, but I find that the people we talk to during the course of 1 week, you have a pretty broad set of skills. So that's kind of a little bit of the background. I'm going to walk you through a few slides here briefly on what Trucks does more specifically, and that will give you a little bit of a flavor for what we do sort of day in and day out. So let me share that with you here. This is the 4 people at Trucks that make the investment decision. So Trucks is a pretty small team anyway, but there's 4 of us that make decisions on investments. And so it's my partner, Puneeth, Kate, and Jeff. And I'll bring up real quickly, I'll mention Puneeth is Puneeth's from MIT. We actually hired Puneeth right out of the IAP program. So he did IAP with us his senior year of undergrad. And then we convinced him not to go to grad school at MIT and join us full time. And over the last year, Puneeth has made partner. So he's basically gone from 6 years from IAP intern to Trucks partner. So he's probably the best person to be speaking with you today, as I said to John earlier, but unfortunately you're stuck here with me. So that's the small Trucks team that makes investment decisions. And here's kind of what we do, at a very high level. We're trying to fund entrepreneurs that are building the future of transportation. And what does that mean for us? The sort of topic areas, the industries are really all over the place. So as I mentioned, it could be bicycles, it could be trucking, it could be passenger vehicles. But really fundamentally what we're looking for is it going to do one of at least these 3 things that meet our mission, our thesis, which is to make transportation decarbonized, safer, and more accessible. And so when I think about kind of qualifying companies in our pipeline, I'm really looking for early stage opportunities that are trying to make transportation better in one of these 3 ways. And when we take an early look at a company, if that's true, then we'll evaluate it. And we'll basically, from our little, our small team, we'll move only those companies forward through our process. So to give that some more specific numbers, we see about 1,000 companies a year at Trucks. In fact, last month or the trailing 30 days, we saw 150 companies, which is a lot more than the normal. Usually it's somewhere around 100. And within that, 100 or so, there's probably only about 30 that are truly qualified for our thesis, where it is early stage and it is checking one of these boxes. The others, might not necessarily meet our thesis, or they might be later stage. And so in our world, that means it has to be seed or kind of pre-seed. If it's a Series B company or a Series C company, I appreciate when people tell me about it, but it's not going to work for our fund thesis. And maybe later in the discussion, I can get into a little bit more how a venture capitalist, and specifically us, how we put together the composition of what the fund should mean and why we have those specific rules about the moment in time where we invest. So that's a little bit about Trucks. We're based in San Francisco, in the South Park area. When I think about the offer for founders, when we've evaluated great companies and we've gotten to the end of our process, and we can talk about that a little bit later too, how we arrive at a yes. But when we do get to a yes, this is kind of the line I like to think about in our head, that, you know, what we're fundamentally doing here is we're leading great seed rounds of great transportation companies and trying to get 10% ownership and trying to have board presence. So 10% ownership is something that we're trying to hit as a bogey for our financial model. If I could have more equity, I can, and sometimes we will, but not too much more. And we like to often share investment rounds with other investors, whether they're small seed funds or family offices or institutions. We often like to have other investors around the table over those multiple rounds that a company has to kind of live through as they're trying to figure out the product and the market. And ultimately, we find that early on, there's not yet a full board like you think about a board of directors at a public company. Usually when we're investing, we're usually often the first kind of big check in a company's life. And so we're helping the team get the board put together, and often think about the board that we're a part of is like almost like a Fisher Price board, where the founder might have never run a board meeting before. And it's not necessarily my job to sort of go in there and point out how inadequate they are, but it's actually to get them ready so that 2 or 3 years from now, when there's maybe a broader set of investors and a Series A financing, that they're prepared for that. So we kind of just call that board presence. And sometimes that means I take a board seat, sometimes just a board observer. I'll give you a flavor of kind of some of the things we have invested in. And so one example would be Gatik. This is a automated middle mile truck. And we made this investment during our first fund. I think what's interesting about our model is we tend to have somewhere between 28 to 32 investments per fund. And so the first fund that we did, we launched it basically the last few days of 2015 and went for about 4 years as the investment period. And within those 4 years, we made about 30 investments. Gatik was one of those companies. And during that period, it was definitely, you had the huge boom of automated vehicle companies overall. And at one point, it was probably 80% of our pipeline was just automated vehicle companies. And we were smart enough to, identify certain segments within AVs that we knew had tremendous business value. But I'll admit that we're usually not smart enough to pick just the one company at seed that is going to be the great company. So, we usually do 2 or 3 investments in a cluster of an idea. If we really love a topic area, we'll kind of do that. And we're thankfully, we were smart enough to be an early investor in Gatik. And they had a great announcement this week about going into more sort of volume production with Isuzu on a truck that they've been working on. So we're really happy with what Gatik's done. And from that first part of the portfolio, I think representative of a lot of things we like, which is autonomy to a specific business unit, and some great progress over the years. Another one is JetZero. This is a more recent investment. We made our first check in this company in our second fund, which was a few years ago. We wrote that first check. It's a blended wing design. So I'm sure there's more than a handful of people on this call who have spent time in aviation and defense and have seen prototypes that are of a blended wing kind of variety over the years. And the early team actually that developed blended wing in and around NASA and Boeing is on the JetZero team. So we're really excited about this one. We have a rather large position for our fund in JetZero. And last summer, they won a pretty significant Air Force contract so that they can do a full 1-1 example of the vehicle and fly it by 2027. And if it succeeds, it'll be a combination of both a commercial airliner and as well as a tanker plane for the military. The key insight about JetZero isn't a new type of powertrain. It's actually just the shape. So by moving to a blended wing, you have a design that, as opposed to a tube and wing, almost the whole thing generates lift. And so even if you use off-the-shelf engines, you can get something like 40 to 50% lower fuel burn, which is significant and would allow you to go into, for example, if the military needs to use it to go deeper into the Pacific, that would be a good utility for this plane. So that's JetZero based in Long Beach. Charger Help is an investment we made in our second fund, and this is our thesis around the importance of charging and infrastructure. So this company is a combination of software and workforce so that chargers can get back up and running. And particularly at the time we made the investment, the insight was that about 30% of chargers weren't in service, for the majority of the day. And now with new types of funding that are associated with charger uptime, this is even more important. So there's certain types of funding and sort of tax benefits you receive, both as an asset owner and one of the networks, if your chargers are at a certain level of uptime. And for those of you, here on the Zoom that drive an electric vehicle, I'm sure you can sort of sympathize with how many times you've been to a charger that's out of service. And so Charger Help is essentially that entity that's helping their customers, usually a B2B customer that has a fleet or has a large network of chargers, whether they're a real estate entity or a manufacturer, something like that. That's what they do. And then finally, River, this just kind of points to the fact that trucks will usually, our investments are in North America. But when we think there's a big enough opportunity, we'll go to some other geographies. And River is the first investment we made in India. It's probably not the last. And they're building a high utility two-wheel electric vehicle. I think of this as almost like a Defender 90 of scooters. So it's actually quite a handsome vehicle, but it's handsome because of its utility. So it carries way more payload than you'd expect. It's much bigger and kind of brawnier. And it's amazing what the team at River has done to bring this vehicle to bear with to production with not a lot of financial resources, certainly just compared to US startups, and also just the amount of time it's taken. It's only been really a few years, and now this vehicle is in production in India, and you can buy one today. So that's kind of what I wanted to give you a flavor for. And then I think John and I are going to have a discussion about some topics, and just excited for his questions and ultimately yours. So
thank you so much, Reilly. That's such a great intro to what you guys are doing. My first comment is really about your thesis, which focuses on, what do we want out of transportation? We want decarbonized, we want safe, we want accessible mobility. And I just want to say it aligns so perfectly with our three objectives at the MIT Mobility Initiative. I mean, we use the word clean instead of decarbonized to be a little bit broader, but those really are the three massive goals that we have for our system. And I know there were some questions in the chat about inclusivity and accessibility, and I think we'll come to those in the discussion following. So just
maybe one thing to add about that as you're bringing that up is we have such a small team that we naturally had to build a lot of process into what we do. And our thesis is also a filter. So, a lot of the words that we use, we as a group, I think we tend to want to reuse them. And those three words, when we were first starting trucks, to be honest, we only saw probably maybe 5 companies a month. So we didn't have to be very organized about the new company pipeline, and we could spend a lot of time evaluating all of them because there weren't a lot of companies. Yep. What happened after, particularly if you look past Q2 of 2016, which is when GM acquired Cruise, there was a huge uptick in our pipeline because we were one of the few companies looking at transportation startups. And it was at that point, only at that point, we're like, wow, we can't manage this from our inbox anymore. Like, we have to actually get smarter about how we look at these companies. And then we kind of realized after that, hey, we should probably have a filter for things that we do and do not evaluate, because what a waste of time if we spend an hour evaluating something and then go into a partner meeting and then all of us as partners say, well, we don't really want to do one of those ideas. So instead, what we came up with, and frankly, my partner Kate really championed this, was these are the 3 things we really care about for transportation and the investments that we would be very happy doing. And so let's just use that as the filter. So if you don't have one of those, then we just won't waste your time and our time doing it. A good example of that would be like putting ads on the top of a Uber or like the little ads when you get an Uber that, show like, P&G ads and things like that. Doesn't necessarily meet one of the things that is in our thesis. It is theoretically a transportation idea, but we wouldn't spend time in it. So the filter for us is also the thesis.
Absolutely. Absolutely. You mentioned early on that, there's this distinction in the industry between the generalist and the specialists, and, why you felt it was important to look specifically within the transportation ecosystem. So, I mean, just to start out, let's talk a little bit about mobility tech at a very broad level. So reflecting a bit on that PitchBook data that I shared, where, we have seen a significant decline. That's not just in mobility venture capital investment, that's across many, many sectors. So I want to ask you, like, what's going on out there? Do you feel that we sort of went through a bit of a bubble? What drove so much capital? I mean, if you think about it, we were in the middle of a global pandemic. Nobody could move, and yet oceans of capital flowed into technology that enables the movement of people. It's a bit bizarre, right?
Yep.
How do you think about sort of where we are in that cycle, and sort of the ebbs and flows of capital more broadly?
Well, if you look at particularly for 2021, and I think a huge, one of the features of that moment in time is just the SPAC boom and bust.
Yeah.
And there were something like 35 automotive related entities that SPACed in that window around 21 and 22. And to be honest, a lot of the companies that SPACed, just should never have been public entities. They were still fundamentally very high risk companies that should have remained private, but so many of them were running out of options in the private markets. And if you were, let's say, a 6 or 7 year old company, and you were getting dry on raising money in the private markets, and a banker showed up and said, "Hey, everybody in this room is going to be, a multimillionaire. We're going to make this thing public, and you're going to have an additional 500 million over the next couple of years to go support the business." It was really hard for founders to turn those opportunities down. And so I don't know if it's 100%, but out of that 35, there's probably only 2 or 3 really good companies that should have been public in that whole group. And what really happened, if you think about it, was it was forcing the risk profile of a lot of the work that I do on public market investors. So I'm more than happy to take on the risk of looking at private companies, accepting the risk, evaluating them, and paying a certain price. That's a lot different than if you were to say to somebody who's looking at their retirement portfolio in a basket of public equities to evaluate those companies as if they're on the same plane. And that's really what the SPAC acceleration did. And so a huge part of 21 and 22 was a lot of the funding that went into those companies before they SPACed, when they SPACed. And then there was obviously a huge amount of interest in things like logistics and delivery, which were another big chunk of that moment in time, which was a feature of, being at home, was getting delivery and things like that. So there's so many fascinating parts of that 2021, 22 era for certain. But SPACs are definitely a part of that for sure at some point there'll be a great book about the SPAC era and case studies that we can all read. But we lived through it a little bit.
Yeah, indeed. And SPAC being special purpose acquisition company, for those of you who don't follow this as closely, it was quite a phenomenon in the markets. Now, looking forward, what are you thinking about sort of prospects for the future flows of financing into mobility technology? And here I would just like to reflect on one of my favorite quotes, which is from Roy Amara, who is the founder of the Institute for the Future, an MIT alum. And he famously said that we tend to overestimate the impact of technology in the short run, and we tend to underestimate the impact in the long run. So as you think through about technologies that are part of a broader system that involve um, people and institutions and government bureaucrats and things that are so far beyond their direct control, overall, are you feeling like we're at about the right level of investment flow into mobility technology, or are you thinking long term this is really going to be a transformational space and there's a long runway to go with mobility tech?
It's a great question, because I feel like there's in some way points back to a little bit of the reason why I like investing across all of transportation, because all of these industrial categories are highly cyclical, even whether, not just because of the market we're in now, but at any point in history. And so when new car sales are up, used car sales are down. And when, there's not as many new cars, then the service and parts businesses are doing great business. And so there's all these different they're interlinked. There's different time cycle to the way that these industrials move, particularly at the investment stages that we're at. So that's always been why we have believed that you have to sort of accept and appreciate the industry of industries that is transportation, because theoretically, if you're good enough, you can always spot things that are undervalued. And VC is really about placing a bet on something that no one really thinks is a good idea, but 6 or 7 years from now, everybody will accept as an obvious part of how we live. And so you have to be a little bit in front of that. And all these different markets contribute to opportunity, I think. So that's maybe one way to think about it. When it comes to funding overall and kind of like which parts are undervalued and undervalued, I will reframe your question a little bit. It's interesting how few companies we saw in automated vehicle for on-road in the last 24 months. And so, as I said before, we see about 1,000 companies a year. And just in the last couple of years, that number, was dwindling to like less than 10 of new companies out of 1,000 a year that were for on-road autonomy ideas. And that's a huge contrast. So like if you went to our pipeline in 2017, 2016, it was like 75%. So it's almost like a lot of the seed corn for things that we look at as a business, like fundamentally changed. And it's always changing, but particularly around autonomy. And I think what's happened in the last 6 to 9 months is fascinating for two reasons. One, capital, and also technology waves. So there are two investments that SoftBank made in the last 6 to 9 months. One is Stack AV, which is the former Argo founders, mostly focused on commercial vehicles. I think it's unclear which commercial vehicles right now, but we can probably guess that they're trucks or something like trucks. And then the other one is recently Wave, right? And so you have one of the largest sort of capital allocators in the space coming back in.
And these are billion-dollar plus SoftBank investments back into the autonomous space.
$1 billion each, right? So, and then you have another thing, which is just, all of us have seen and played with AI tools and thought about how that would impact our business. But definitely when it comes to the way that robotics companies have thought about building their stack, I think there's an incredible sense of excitement that we've seen in our pipeline of just new things that take advantage of diffusion policy and things like that. Even just kind of remarkable ideas that are only 6 to 9 months fresh, and the ability to, feed in 25, 30 examples to diffusion policy and then basically have it output controls is pretty phenomenal. And so yeah, there's all sorts of stuff like that gives me a lot of excitement. And I think that if you look 12 months from now, there'll be a lot more AV startups that are brand new. So it's a little bit hard to answer the question of like, is overall spending, the charts are real, but I think within these certain categories, it moves up and down pretty rapidly.
So, we've also had folks from, BlackRock, Bank of America, sort of the big investment banks and that community join some of our discussions on financing of mobility. And if you could just help everyone to kind of contextualize, what's the role of venture capital, and in particular for trucks, looking at the seed rounding versus the big money, so to speak. So if we think about real electrification of our global mobility system, and we just think about the billions and billions of dollars of investment that has to be made in building up battery production capacity and so forth, how do you sort of, what could you share with us that puts that into context, the role of venture capital versus the role of financing overall?
Yeah, I mean, I think that most of the time, these different financial partners, particularly if you're a researcher or you're an entrepreneur, the appropriate finance partner should be picked at the right time. And so the amount of risk that we're willing to take on and the work that we do is totally different than somebody who works at, Temasek or BlackRock or something like that. And that's fine. And if you think about it, I wouldn't say we're the most important, because I think all the partners throughout the company's life are probably, particularly when you get to hard tech and robotics, there's so much capital that's needed for these companies that all of those stages are pretty vital. But we just happen to be usually the first. And so one of the, I think, qualities of early stage investors, and I know on our call we have, in the room, there's a handful that we've worked with, from Jessica and Assembly and Josh Berg from Magna, among a bunch of others. When you're doing this work with a founder for the first time and they can't get the round off the ground, and you're helping them through that, and ultimately you do get the financing together and you help them get their first customers, there's a aspect of the work which is probably closer to being a co-conspirator or kind of like a close friend in those moments, because nobody's really sure that the company can even exist. We often talk to founders before they've left their jobs at Google or Facebook or Dropbox or Uber or something like that. So we're kind of still putting together the whole idea of like, is there even a company here? And when it does come together and you actually can show that there's proof of life there, it's something I think personally, which is why I like doing this stage of financing more than something later on. Now, I'm sure that if you talk to somebody later on who is doing Series D investments, they probably think the work that we do is pretty strange. But we're all kind of a necessary set of components and stages, almost like a book, right? You have to kind of get through these chapters in most cases.
But I think you're highlighting this is about so much more than money, than capital. This is about relationships. This is about insight and know-how and understanding the space, the service that you guys are providing. Let me ask you this: how do you think about the vetting process? I mean, you mentioned 1,000 companies per year. How do you manage that pipeline? And without giving away your secret sauce, of course, what can you share with us about how you guys vet these companies?
I mean, there's really no secret sauce other than I think that we have to unpack the risks of the company as best we can. That's kind of the thing that we've always focused on at Truck. So I often think about early stage investors. You can choose, I think historically we thought you can choose one of two paths. You can, and if you've ever been to, maybe there's some cafe like this in the MIT area, but it's around Stanford, there's this place called Cafe Barone, which I always think is like a great people watching and people listening, because you have usually like angel investors talking to the researchers. And I have had so many experiences at Barone where you overhear somebody who meets a Stanford, postdoc, and then decides by the end of their latte to give him $50,000. And most of that is just based in the fact that they, really like the person or they're inspired by that. And so early stage investing can be that sort of from the gut part of how people would treat their investments and how they evaluate. There's another approach which is highly analytical, and I think at early stages actually over analytical, because often what we're doing is looking at things that don't yet have any product in really any revenue. So you could potentially miss out on a great company because you were being overly analytical about it at seed stage, when really you should have given it a little bit more time to bloom. So we kind of looked at that in the early stage of trucks and thought, well, let's try to combine, frankly, the best parts of both of those, right? Like, let's not just shoot from the hip and just meet people for coffee at this place and decide we like them. Let's try to unpack the risks as much as we can, but then also let's try to listen to how we feel about these founders and being, frankly, tied to them for 10 years. And there's two questions that we've come up with that we, at the bottom of our risk evaluation form, which is mostly analytical. The two questions we ask are, would I tell my spouse to take a job there? And would I tell my friend to invest? And those are these highly imperfect, but really fascinating two questions that get at the right side of the brain. That's as close as we can come to the sort of gut feeling you have about people. And what I find is that they kind of trigger different parts of all of us and how we think about riding along with these people for this quite long journey. And so if you get to the bottom of this evaluation and you've tried to unpack the risks as best you can, and we, by the way, think there's 8 areas of risk that we like to focus on, and we check these 2 boxes, that's a pretty good signal that we want to continue talking to this founder. And to get to more clarity on your question, in a yes situation for us, when we move the fastest, it can be about 5 to 6 weeks if everything is totally lined up and there's no holidays and stuff like that. I think in this market, we haven't felt the pressure that we had to move that fast because rounds have taken longer to come together. So if it takes us 7 or 8 weeks, that's totally fine.
It's fascinating. So it seems to me like we're a long way off where an AI tool can effectively do your job. I think
maybe. I mean, I don't know. I feel like all the AI demos I've seen have been pretty amazing. So, and really what we do individually with financing is not that unique. But I do think one of the unexpected parts about venture that I didn't think was going to be a value is the work that you get to do with your partners to make these decisions. Because if you think about trucks is no different from a lot of other VC funds in that we see a huge funnel of ideas and we only make a few investments. So we turn 1,000 companies basically into roughly 6 or 7 investments per year. What that really means is that the bulk of what we're doing is saying no, right, to 994 companies a year. And if you say no together as a team a lot, there's some really fascinating dynamics of saying no as a group that over doing this for 10 years, I've learned to appreciate are kind of a feature of the job. What I mean by that is if you, John, let's say you find a great founder at MIT and you're a partner on our team, you bring it to the table and you're like, I just love this founder. I've known him for 10 years and, we're definitely going to do this investment. And for some reason, just the other partners don't like it. Your first reaction is to hate your partners. And so your thought is like, I can't believe these people don't see the value in this, MIT student. This is going to be great. And so one of the biggest challenges in saying no that many times is to do it in a way that makes you feel good about your partnership and wants to make you come back and actually find great deals and do great deals together as a team. And I would admit, when we first started trucks, I had a really hard time personally just kind of going through that process, because if I found a deal and we didn't do it, I would feel somewhat embarrassed to tell the founder no. And I'd feel somewhat angry at my partners because we didn't do the deal. And why didn't they see the brilliance that I saw? Mm-hmm. And after doing that for a long time and doing many deals, like getting deals all the way to the finish line and not doing them, I realized that, man, what I really love is the work of working with my partners together, and eventually softened up to the fact that, like, if a deal doesn't work, it still stings for about maybe like 9 minutes now. I mean, it used to take me like 90 days probably. I'm making that up, but like it was a lot longer. And now I realize, like, okay, that's just part of how we work. And I'd much rather get to an investment where we all want to do it, as opposed to like I, fought and tore down the house just to get this one investment through, and at the expense of my whole partnership. And so thankfully at Trucks, I think every fund kind of goes through this as a team, but we definitely had to go through it. Now we're on our third fund, and it's part of the work of VC, is kind of what happens behind the wall between these individuals, which is unfortunately why I have friends that might have done one fund together with, another partner and then didn't do a second fund together. And so that little dynamic is definitely one of the critical pieces of the business of venture capital.
I'm sure what you're saying is resonating with Laura and Jessica and some of the other folks in the industry who have joined us on the call today. I'm going to turn it over to Bhuvan because I know the chat has been active. So Bhuvan, could you share a couple of the questions, please?
Sure. Thanks, John. Yeah, the chat has been hyperactive, so I'll get right to it. Reilly, you mentioned that you all invest across the gamut in the transportation space. So Clinton had a question that whether there's an intentionality in funding startups that complement one another, as in, if you're investing in an EV trucks company or something like that, that may need an EV SE. So does that mean more effort goes into looking for startups that focus on an EV SE for EV trucks? And just flipping that question around, Raur Patullo, you make multiple investments in a focus area. So has this ever resulted in you sitting on the boards of company that could eventually in the future be potential competitors? And how do you all manage this potential conflict of interest which may arise in the future?
It's a good question. Thank you for your question. I'll answer the second part first. So usually it has not come up as a conflict. And part of the reason for that is even when companies look the same when they start, they're always different, even 18 months, 24 months down the road. So we've never run into an incident where we're backing we wouldn't, like in an example, like I showed you JetZero, you're doing a blended wing airplane. We wouldn't back another blended wing airplane. But we might do something else, which is an airframe and, flies or something like that. But down the road, probably not the same size and same market. So they're never that close, and companies flip and flop and pivot. So that's never been a problem for us. When it comes to the complementary aspect, not really. But we do have, fortunately, our fund is backed by some awesome LPs who are deeply involved in building vehicles, building components, insurance, things like that. And so we'll often think about like, I wonder if one of our partners could help them like figure this piece out. We'll do that.
All right, thanks. Just taking a step back about, the VC as a funding model, it's built on the eventual exit of the investors. And, you typically look for, high margins and or high volumes that justify the high value at exit. And transportation typically is, very tough business. It's hard and expensive usually to scale, low margins. It takes a lot of time. So is VC a good funding model match for transportation? And are there other funding models that, potential startups should be considering as well? And how long do you all typically, what's the typical management period length? And is there a special situation that triggers the exit, or do you all just go by the terms of agreement that you all signed at the start? So that's a lot to unpack, but yeah, we're short on time. So.
Yeah. The time period for a typical VC is usually 10 to 12 years. And you're usually making the investments during the first 4 to 5 years. And then the second 5 years, you're harvesting those, giving them maybe a little bit more capital and helping them get to ultimately an exit. And I think that, one of the first part of the question about is venture appropriate for transportation? We like B2B categories. It's one of the few reasons we called our name of the fund Trucks. I often think the commercial vehicles are the best first customer for new technology because there's so much business value. So, like if you try to sell widgets and you try to go into the passenger car market, very difficult. The sales cycles are really long. So if you can go into commercial, there's a really great amount of opportunity there. And particularly in our space, 2019, there was this ELD mandate, which meant that all commercial trucks in the US had to do things like electronic logging of data, which the upside of that is it meant that software was almost mandated in the cab. And it saw this blooming of logistics startups after 2019, which we're still seeing. So there's certain categories that kind of pop off because of regulation and things like that are still B2B and still huge opportunity.
So yeah, there was a question like early on when you mentioned, your three decarbonize, safer, and more accessible. So Matthew, had a question like, could you like expand a bit on more accessible, inclusivity from, what point of view? And Iori Mori had a question, safe and accessible from whose perspective? So I'm just trying to combine both those into one, and your thoughts on those.
Sure. There's a good example. There's a company called Token Transit, which we invested in, that is basically just making it really easy for transit authorities to accept digital payments, including going down to the point of like when you book a concert ticket to potentially have a transit pass attached to the digital ticket you'd have like going to a concert. So those are good examples of just kind of making transportation more accessible. But it's definitely the category that I think is we probably see the fewest number of startups now. There was a smart city kind of boom 2017 through 2020, which we haven't seen pick up again after COVID. Obviously, a lot of those companies during COVID had problems because people weren't going to city centers. And since, the kind of, COVID trail off, we haven't seen a return to smart city kind of related ideas as much. And so we haven't seen as many of those companies in the last 2 years.
And probably just get in a last one from Professor Joe Ferreira at MIT. In evaluating and shaping risk and opportunity, where do regulatory risk, public acceptance, and social responsibility fit in? And also, do you take steps to bring in expertise to help shape or steer a company? Because these increasingly appear to be a growing part of mobility tech adoption and acceptance. So.
Regulatory is definitely an area that not every, but particularly the ones who are doing on road, is a huge question. And frankly, it's almost the same surface area as business development, if you think about it, because the big question for a lot of those companies is it even legal for them to operate? And who would we need to speak with to even understand that? We're going through one at the moment that's deep in our pipeline that is in the electric vehicle space, and it's kind of related to commercial trucks, and we're just trying to figure out how legal it is. And so we're talking to a few attorneys, talking to former FMCSA individuals about it. No one really wants to go give us a definitive answer, by the way. And so we are constantly playing in those areas. As a result, we tend to have a lot of close relationship with lawmakers and policy people, not to browbeat them because they don't really care about us so much, but just to kind of get an opinion of how they're thinking about this. So we are often bringing in experts, whether they're attorneys or policy people or, shops are specific to that. And then when it comes to kind of overall, like the role of transportation companies, I think transportation is one of those areas that will never get to the end of the problem set. So it's a little bit like investing in healthcare. I think there's not like one investment we're going to make that solves all these issues. Like it's in that way, I think selfishly, it's a great long-term investment thesis for anybody that, wants to spend their life in venture. Transportation is filled with all these kind of complicated issues that I think, to be honest, and because of the work that you do, John, and the forum here, like it requires smart people having frank discussions about these very complicated topics. Because there are certain things that you do in transportation that certainly, that benefit one category at the expense of another. And without spending another hour on this, which I easily could, we've basically just overspecified vehicles and made them way too heavy. And so in an effort to make them safer, which is a good idea, we also made them only safer for the inhabitants at the expense of a lot of other things. And there's never been a very full, sort of wide-ranging idea of what automotive and transportation safety is. It's usually one group pointing their fingers at another. And so that's why I think it's a great area of discussion and also for investment. But it's
Thank you. I'll pass it on to Jinhua now.
Okay, yeah, sorry to interrupt. It's such an interesting conversation. Reilly, really thank you for both mentioning the kind of the framework thinking that trucks have, but also appreciated the part you described the emotion up and down, and when you bring ideas being rejected by partners, how this fellowship among these partners grow along with the journey. So this is really a beautiful description of this process there. And I think in many other corporations, research institute, our own personal life, all share this type of structure there. I really appreciate that. Thank you so much. Right.
Yeah,
so,
thank you.
Yeah, actually, I would like to invite everybody. Actually, thank Reilly for joining us today for the conversation today. Thank you so much, Reilly.
Thank you, Reilly.
Great. So in the last 2 minutes, I'll just recap these terms, mobility forum, just very briefly. First of all, as I mentioned, that I really encourage people in the chat, type in your expectation for the fall 2024 season, which we'll start to design and implement here, right? You can talk about specific technologies, methodologies, AIs, machine learning, all the whatever that's enabling. But also you can mention what are the social relevance, what's the social agenda, the problems, the challenges that either city or the broader society is facing there, right? The third thing is if there's any particular region or city or community that you want to drive our attention to, please also name that as well. Yeah, please direct type in the chat. We'll try to compile them and hopefully implement as much as we can in the fall. So as a quick summary for this term, I just to share this again here. We start from cost sharing, has a final come of age at the very beginning with the panel discussion. Then the second part, we start to look at the labor issue, the whole training of the talent, if we are transitioning into the electric vehicle era. The third part, we'll talk about public transit, the particular fiscal problem, the fiscal cliff we've been talking about facing the whole industry. Then Professor Reid Elwin talked about the minor cost of urban sprawl, looking at the building environment's impact on all aspects of our life. Elsa described the electrification, the upstream, the supply chain of the materials, what the challenges, risks. Then we have a couple on the safety one, on Fred Mandarin, talk about highway safety, particularly with the forthcoming autonomous vehicles. And Joe Zardini talk about how to design the complex system more from the methodology point of view. Sam Madden talk about the safety again, looking at how to change driver behavior. Professor Pat McCarran talked about the specific econometric problem of selection bias and how to recognize them or what to do with them. Then we had the Deputy Secretary from US DOT, Polly Trottenberg, talk about how the federal programs are impacting urban transportation at the municipal level. Then we have a session on the technology in the transit, or payment and benefit, etc. I think, Reilly, you mentioned the token transit maybe belong to that category on this innovation, the public transit payment system. Marco Pavon talked about how the foundational model, the generative AI era, how that changes or influences the development of AV. Then last week we had Nat Boone talk about the safety issue in facing autonomous vehicle. And today, Reilly, so thank you so much for actually concluding the forum, talk about how the venture capital play a role in the context of the mobility development or transportation industry development, right? So I have to say that this is the 14 sessions that we've accumulated, and today actually represent the 112th session. We have accumulated the rest of all organized in this place. For the audience, as a way to guide this process, we actually organized by the different topics. You can easily browse through them here, right? So that's the part in this term. Lastly, I'll just say that when we started this 4 years ago, I actually had a worry. I thought at the beginning, people have all this passion, momentum. A lot of people come here, but the passion may dissipate quickly after 3 or 4 months. But it turns out this is 4 years on, there's still so much energy coming from the audience here. So I really thank all the speakers as well as the audience for making this forum possible. Again, please keep typing your ideas into the chat. We'll compile. Without that said, then I will wish everybody have a beautiful summer, and we'll see you back in September 2024. Goodbye, everybody.